This is part 2 of our chapter 1 video lecture, where we're going to be discussing additional issues of the equity method. So the first issue is when we change from that previous fair value method to the equity method. And the same rules pretty much would apply if you change from the equity method back to the fair value method. Let me illustrate again the percent ownership. Remember now that if you have less than 20% interest, you probably don't have significant influence over the investee company. So the investor is going to be using the fair value method of accounting for that investee. Now, if you have 20 to 50% ownership interest in the investee, we're learning that now you use the equity method. So maybe you own just a little bit of interest in the investee, so you're using this method. And now you acquire more to take you over that 20% to 50. So now you're going to switch over to the equity method. For past financial periods, you would keep your old method and don't go back retroactively and change. Yeah? We call this prospective. From the point you have a change in percentage ownership, only from that point forward, you would use the new method if required. So initially, you're going to record things at cost and eventually adjust it to fair value if you have that less than 20% interest. But now when you get more than that 20%, you're going to switch over to the equity method. Here it mentions prospective. You only from that point forward would apply the new rules. Anything in past periods, you do not restate them for the new rules. So our example, we have Alpha, who's the investor, acquires only a 10% interest in the investee Bailey. That's at the beginning of 2023 at a cost of $84,000. So this is the initial cost basis we have to record. And then we don't have any significant influence, so that justifies the fair value method to be used, reporting dividend income, and then adjusting the investment asset either upwards or downwards from this cost whenever we need the financial report done. So we started off here on January 1st, and we paid 10% of this, $84,000, even though the investee Bailey's equity, net assets or book value is less than that, probably because there's some understated assets. We're willing to pay more. Here you can see that by the end of the year, the fair value has increased. In the case of our investor, their investment went up by $5,000 more, again, 10% of this amount. So we need to make an adjustment showing that amount as income from equity investment. Again, we need to adjust up to this $89,000 by the end of the year. And because we don't have significant influence, the book value of the investee doesn't matter. Again, that's given to us over here. Yeah? If we had significant influence and paid more than the net book value, then again, we would have to identify those understated assets and then either amortize or depreciate them, if applicable, over the rest of their useful lives, decreasing the investment income. But that's not the case here because we don't have significant influence. Now, we're told at the beginning of the next year, our investor Alpha buys an additional 30% interest in the investee. And here's the costs. Okay, so this is the starting point for the second year. We had increased it up by $5,000. And now we're going to add the additional cost of buying that 30% more. So we had 10, now we're going to have 40% interest, giving us probably significant influence, meaning now we got to account for the investment using the equity method here in the second year. Okay, significant influence. So because of that situation, at the time you acquire that significant influence, we gotta identify how much unidentified assets there are, undervalued assets. So we go back to the table. If you look at that end of the first year, really this is the beginning of the second year. The difference here is that unidentified assets, of which now our investor owns 40% of that. The identified assets, the difference is that 175,000. And is that right? Value. And 40% of that is what we got to account for. Here in this case, depreciating or amortizing it over the next 10 years, reducing the amount of income now we're going to be reporting from the investee. So the calculation, here's the beginning of the second year. Here's the cost to pay for that additional 30% interest, debiting, increasing the investment asset. So also at the beginning of the year, we need to again figure out how much of that additional cost is going to go to that unidentified or undervalued asset. So here's our initial 10% interest at cost, plus the $5,000 more adjustment for last year's investment income. And here's the cost we just recorded up here, increasing the investment to get our 40% interest at the beginning of the year. But what is the book value of that 40% interest? Again, let's go back to that table. 40% of this number here is what's on the books of the investee. Yeah, 40% or this amount here. So we paid in excess of the book value. The investor paid $70,000 more. Now, why would they pay that? Because there's a asset that's undervalued. That asset, we're told, was a patent. The patent is going to have a 10-year remaining life. So this $70,000 has to be amortized, reducing the investment income allocated to our investor over the next 10 years. Notice we don't have any extra unidentified assets, so no goodwill here. So we're told at the end of the second year, the income of the investee, 40% of this is allocated to the investor. So we increase the investment asset of the investor and crediting the income account. But notice it's not 40% of 130. Yeah, we need to take into account that amortization. Remember the 70,000 patent costs amortized over 10 years to give us 7,000 more of costs being used up. So reducing the income, reducing the asset, netting these out over here. And if any dividends are paid, we learned under the equity method, that reduces the investment asset account because we don't report any income under the equity, dividend income under the equity method. And then these two receivables just cancel out to show the cash eventually being collected for the dividend. Okay, so that's the equity method switching over from the fair value method. The next topic is comprehensive income or other comprehensive income. Let's see if I can illustrate this out. So we know overall revenue minus expenses is equal to the company's net income or net loss. But there are certain types of income or losses that are not included in the revenue or over here in expenses. And that's the other comprehensive income. So examples you probably learned in a previous intermediate accounting class was gains or losses in foreign currency exchange. And we'll maybe cover that in more detail in a future chapter this semester. Also, adjustments to pension costs, maybe really a deduction most times over here under other comprehensive income. And maybe unrealized gains or losses from derivative transactions. So when you combine the net income with the other comprehensive income, you have total comprehensive income. And I guess the offset, this is of course on the income statement, and the offset on the balance sheet, we know that net income here is eventually closed out into the retained earnings account. But you don't do that for the other comprehensive income. We have a sub account under retained earnings called accumulated other comprehensive income. Yeah, just to keep it separate because we separate this comprehensive income from the net income. Yeah. And everything here just to balance off. Now, the objective here in this section of chapter 1 just says if we're looking at the investee, this is the income statement for the investee. We know we pick up a percentage of this net income as income on the investor and adjust the investment account. But we'll also do that for the comprehensive income, a percentage, and we keep it separated from the net income, just like you see here on the investee's financial statements. Yeah, also adjusting this other accumulated comprehensive income in the equity section of the balance sheet. Okay, so that's what really this whole page here is. Yeah, again, read the textbook for more detail. Let's move on to the next item, and that's recording losses from the investee. Sorry, I'm struggling with a text box on my screen that you probably don't see. Okay, so we're looking at losses. And just like income, the investor has to recognize its percentage share of the investee's loss. But in addition to recognizing that percentage loss, if there is a impairment to the investment, a so-called permanent decrease in value, our investor has to report a impairment loss. So we're reporting a share of the investee's loss. We're reporting impairment losses, all decreasing the investment account. One thing about reducing the investment account, you cannot reduce it to go negative. So here on the next slide, if I can get there, it says you cannot reduce it below 0. So if you now have a 0 basis in your investment and there's still more losses flowing from the investee, those losses are not going to affect the income of the investor. The term is called not deferred but suspended losses. And those suspended losses are not going to be reported. You still have to keep track of them, and you're going to use them up if in the future there's going to be investment income coming from the investee. And you still keep your asset at 0 until all of those suspended losses are used up. Only then, if you have more investment income being reported by the investee, now this investment account is going to go up. And again, now you can offset any future losses. Okay. Again, your investment account cannot go below 0, even if you have more losses being allocated from the investee. You suspend them and you use them up for future investment income, to offset future investment income. Let's sell our investment. Okay, here under the equity method. So just real basic. Remember when you sell stuff, you have your sales price and minusing your costs. And if the sales price is bigger than the cost, the excess is a gain. Gain is like revenue, revenue reported with credits. Or if you have a loss, loss is like an expense reported by debits. The sales price, most times, if you think about the simple situation, is the cash you get when you sell something, debit cash. And here, you're getting rid of the investment asset. You're reducing this asset, you're crediting the asset. So debit cash, credit the investment. And again, if this debit is bigger than this credit, the excess credits are going to go to a gain revenue account. And just the opposite to balance out, you're going to have a loss. When you sell your investment, again, you may go down from the equity method, having significant influence, down to no significant influence, but you go back to this fair market, fair value method. Yeah, and again, you don't restate any prior periods um, financial reports. Next topic, we're going to sell merchandise between the investor and investee. And two possibilities here, right? We can have the investor selling to the investee or investee selling to the investor. And because we have some influence between the two, right, we possibly can manipulate prices. We can manipulate when things are sold, how much is sold. So, because of that situation, we're really not going to report all of the gain at the end of the year if there's still stuff unsold by the company that bought the merchandise. Here, in this case, from investor selling to investee, we call that downstream sales, or from the investee selling to the investor upstream. And again, if the buyer doesn't resell everything out to a third party, yeah, the buyer not reselling everything out to the third party, our investor here has to defer part of the profit for that things that are not sold, probably to next year's when it is sold. So let's take a look at an example. We have a sale of let's see, 30% of sales, gross profit. This is a downstream, the investor selling to the investee. And when we sell, they're going to make a profit of 30%. So here's the sales price. So that means the cost of goods sold is 70%, 7,000, and the gross profit is 30%, $3,000 here. So when do we report all of this $3,000 profit? Well, under general accounting rules, it's when you sell. But because you're selling to intra-company, intra-entity to your investee, you may not be able to report all of this $3,000 profit until your investee sells all of that $10,000 amount you sold to them. Okay, in this case, we're assuming none of this 10,000 was sold. Let me try illustrating on a blank sheet of paper here. If I can remember, I'll try come back, take a look at the numbers here. Let's see. So this is our investor that owns an interest in the investee company. Now, what is that percent ownership? We're told it's 40% here. Yeah, 40%. And our investor is selling, we'll call this sales, minusing cost of goods sold equals a gross profit. We're told the gross profit percentage is 30%. 30% of sales of 10,000. So that's 100% of itself. 30% is 3,000. And of course, cost of goods sold is 70%. So we're selling all of this to the investee, all 10,000. Now it's $10,000 of inventory sitting on the assets, the books of the investee. And we sold, and investee sold none of it. Of course, other sales probably made during the year, and the investee sold all of it. It's only this probably last sale that's sitting here unsold on the investee's books. So our investor here cannot report all of this $3,000 profit in the current year because this 10,000 of inventory in the investee isn't sold to a third party outside of the group. We're going to have to wait to report all of the profit. But because we own only 40% of the investee, you don't defer all of this 3,000. You defer 1,200 of the profit, postponing it. Okay, you still report all 3,000, but then you're going to reduce the investment income coming from or being reported by the investor. You're going to reduce it by this amount, and then when the next year, when the investee sells that all $10,000 inventory, now we're going to reverse that deferred income. So let's look at the calculations and the journal entries here on the slide. Okay. So again, the profit is 3,000. Not all of it can be reported. 40% of it has to be deferred until all 10,000 sold to the investee is sold by the investee. So at the end of the year, here we're going to reduce that income allocated from the investee by this 40% of the 3,000, and at the same time reduce the asset, not the inventory. Okay, this is not inventory of the investor, but reduce the asset, investment asset. And then come next year, when the investee sells all of that 10,000, we're going to reverse that entry we had made in the previous year, increasing the investment income, increasing the investment asset account. Okay, so that's a downstream example. And upstream is pretty much following the same concept. So let's take a look at the next example here. Upstream. So we have the same situation, an investor owning 40% of the investee, and the investee is selling $40,000 of, let's see, costing the investee $40,000, selling it to the investor for $60,000. So the profit we made is $20,000. Of the $60,000 sold to that investor, the investor still has a quarter of it, 25% or $15,000 of merchandise. So 1/4 of the $20,000 profit, I think it's 20, yeah? 60 minus 40. 1/4 cannot be reported, has to be deferred. Okay, let me go through the facts again. We have an investor who owns an investee, just like the previous situation, owning 40% interest in the investee. The investee is selling merchandise at a price of $60,000 to the investor. It costs the investee $40,000. So the investee is making a profit of the difference of $20,000. And all $20,000 can be reported as profit as long as the investor sells all of that merchandise they bought from the investee. But we're told that's not the case. The investor still has, at the end of the year, 15,000 of the 60,000 they bought from the investee. 15,000 out of the 60, that's 1/4 or 25%. So that means $5,000, one fourth of the $20,000 profit. Not all of it can be reported by the investor or the really the yeah by the investor. Some of it has to be deferred until the investor sells that $15,000 in merchandise it still has purchased from the investee. Again, let me see if I can illustrate this on a blank piece of paper. We have the investor owning a 40% interest in the investee. And we have an upstream sale. So sales price by the investee of 60,000. Cost of goods sold is 40. Gross profit of 20. Okay, so all of this is a purchase by the investor, all let's say 60,000. And most of it, 45,000, is cost of goods sold. It was sold by the investor at whatever sales price. We weren't told that. That's not relevant here. What is relevant is what's not sold. What's left over now is 15,000. 15,000 or 25% of that purchase. In other words, 25% of this profit, part of it has to be deferred. 25% of 20,000 is 5,000. But not all 5,000 is going to be deferred because our investor doesn't own 100% of the investee. We only own 40%. So $2,000 of this 20,000 profit has to be postponed. And the way we do that is to adjust the amount of income that our investor has to report at the end of the year. So again, going back, if I can get there, Am I here? Yeah. So here's the profit we have to report. 40% of this, right, at the end of the year, increasing our investment income, increasing the investment. But remember that 2,000 we figured out has to be postponed. So here's a decrease to the income, debiting that income account, reducing the investment account, crediting that income account. Now, when we do sell that 15,000 still on hand next year, what we're going to do next year is reverse the debits and credits to report that deferred income in a subsequent year. Okay, so all of this is done because of this relationship, intra-entity sales. Okay, let's move on to the next topic. I'll let you read this on your own in your textbook, but there's good and bad things about this equity method. Yeah. So some of the good things is it gives you more information. One of the bad things, especially for accounting students, is you got to learn this method. But we're also told there's an option of maybe using the fair value method, even if you own that 20 to 50% interest. So our textbook gives us an example of Citigroup or Citibank that uses this fair value method versus the equity method for ownerships and their investments. And it seems like the authors of our textbook kind of favor this fair value method. Seems simpler, definitely would be easier for teachers and accounting students if there was one less method to worry about. Okay, so this is the end of chapter 2. Make sure you do your homework and your quiz. Before then, go through your textbook, do that smart boy activity. So at least you know the specific topics in each section of the chapter. So when you do your homework or do your open book quiz, you know where to jump to in the textbook to find the rules and examples, and you don't have to come back to this video lecture, which will be hard to search. Okay, I'll see you in the next video.